Welcome to this episode of our property investing channel, where we bring you practical tips and strategies to help you maximize your profit and reduce your risk in your property investing journey. This is your host, Amir Sahad, and today we're going to be talking about general wealth creation strategies, investing in properties and shares, and also property investing using SMSF. Personally, I'm very interested in this conversation as I get so many questions about these topics. And our today's guest will definitely be able to help us to explore these topics with his immense knowledge and experience. Angelo Baronessa is Director of Divergent Wealth and a qualified wealth advisor with many years of experience in wealth creation industry, helping hundreds of people achieving their financial goals. So without further ado, I'd like to welcome Angelo to our show. Angelo, thank you very much for being here.
Not a worry. Thanks for having me.
My pleasure. So just to start with, tell me about yourself, your experience, and a little bit about your journey.
Yeah, so I started Divergent Wealth almost a year ago. That's coming off the back of about 10 years of experience in the industry. The business, the whole idea of why it's called Divergent Wealth is different to the rest and taking you on a different path. So that's the reason why I settled on that name. But in my experience, I've seen the good and the not so good. I thought now's the time to make sure that we can focus on the good. There's been, I guess you can call it, a mass exodus of advisors over the last 4 years. We had about 30,000. I think we're down to about 14,000 now. So we've weeded out what we had to weed out, and now it's focusing on what's good going forward. So as I said, 10 years of industry experience, started off in insurance and grew from there. So my experience comes from a multiple of different advice firms where I've learned best practice from quite a number of places. So quite blessed and honoured to have worked in some of the best offices in Melbourne, worked with some of the best clients that I've ever come across at some offices. So they've been really fantastic. Some of them have followed
Who
me.
is your highest ranked person that you have advised so far? I read it in your website. That's why I asked.
When I can't name drop, but it was
Sure.
at the time, it was the minister, the federal minister for financial services. So that was an absolute honour when day one I started the job and they said, Angelo, you're meeting up with this client tomorrow. And I don't think I've ever told them. And I knew the name. It just washed right over me and I thought, hold on, I think I know who this is. And my boss looked at me and said, you know who the client is, right? And I just said yes. And he goes, it's the minister. And I thought, of course it is. Of course, that's my first meeting. So that was an absolute honor.
Well done. Well done. So just tell us a little bit about wealth advising. How can you add value to your clients?
So a lot of the time, people might have their own journey, they might have their own ideas, and you'll see that they'll create their own wealth strategy. There may not be an art form behind it. It might just be a simple index solution, for example. I'll create a Vanguard as an option and go from there and grow it from that because it's an index. And so a lot of people are reading, I guess, you want to call it advice, or they're just reading blogs, or they're reading up on other people how they've created wealth. And for them, the best that they can offer for themselves is an index solution. So that might be one piece of the puzzle. That's not the full picture, though. You might have other options that aren't available to regular people just on the market. So that's where an advisor comes in and can create a bit of guidance around, well, you might have thought of this side of the picture, and there's actually quite a lot over here that you may not have considered or don't have access to. So we allow that access. It's also knowledge. So as an example, tax knowledge might be something that some people don't have that full awareness of. That's why people will go to an accountant, for example. Accountants can only do so much before an advisor has to get involved. So they'll do your tax returns, they'll give you a bit of tax advice, but they can't tell you and they cannot guide you around investment strategy. They can't tell you start another idea or another option that will help you reduce your tax, because they're there to do your tax returns. Not to say that accountants can't do everything. There's only so much that they can do, only so much we can do, and we work in partnership together.
It is a very interesting thing that you just mentioned, because in these days, I've heard it so many times from my clients. I have talked to my accountants and they advise me to buy a property in that suburbs. Hold on a second. Their accountant, their focus has to be on your tax deduction, not, advising on property or any shares or even managing super. I've heard that many accountants are involved in those areas, which I believe is a heavily regulated area, which you should definitely have a license to operate in that area.
Correct. If you're not too sure if your accountant is able to give you advice, there is a website on MoneySmart for the Financial Advisor Registry, or FAR. If you're not too sure, have a look on there. And the registry shows you who is licensed in Australia or who isn't licensed anymore. So if they're disqualified, if there's any issues in regards to their license, they're not licensed, they won't appear at all. So if you're not too sure if your accountant can give you that advice, check it out.
Fantastic point, Angelo. Thank you for mentioning that. So your role is significantly about planning. You're planning about creating wealth and creating a situation for your client where they reach their retirement, they can live comfortably, right?
Correct.
So let's talk about retirement. We need to know our numbers to have a good plan in place. So how much money a person has to have in order to have a comfortable life for retirement? I understand, it really depends on the situation, the size of family, their expense that they are basically having. So just give us a good amount of information, because this is a very important thing that we all need to know about.
Yeah, of course. So as you mentioned, every person's a bit different as to how much money that they need in retirement, how comfortable they should be in their retirement. Just yesterday, I had a meeting with a client around what do they actually need. So you've got X amount available to you, but what is it that you actually need for you to be able to be comfortable in retirement? So it's a really important question to ask people. Yes, you have access to this much, but how much do you actually want to draw down? Because if you continue drawing down too much in your balance, that's going to have an impact on the longevity of what you've got. So as an example, and these are just stats that are provided by the ASFA, Retirement Standard. These figures came out in last year. So they'll come up every now and then with an updated figure. So for a couple, and this isn't for everyone, of course, but for a couple to have a comfortable retirement, it's around $66,725 a year. So that's just for a comfortable retirement where you might have, say, for example, a few holidays, international holiday every few years, an interstate holiday every so often, entertainment, movies, going out to dinner and whatnot.
Sorry, Angelo, before we move on to your other numbers, what is this number based on? What is the assumption? Is it based on a debt-free house or?
Correct.
Okay.
So no debts. It's basically saying that you're not renting, you've got no debts. This is how much they assume the average person, if they want to achieve, as I said, going to the movies, going out for dinners, nothing over the top, as a comfortable retirement. That's generally speaking what an average couple should, not that they always will, but should be having in their retirement. But that is, again, as a comfortable amount. It depends on, and again, it depends on the person. So a modest person who's single, for example, it'd be half of that, so around $30,000 a year. Or somewhere in between if you're a couple on a modest income. So it might be something around $43,000. So if you want to have a modest, rather than 66,000, it might be 43,000. Again, these are just figures that are provided, and definitely they're going to
Absolutely.
update because of inflation, so that
Yeah,
will, as expected, go up. But there are ways of, if you don't have enough inside of your super or you don't have enough in investments, there are ways around how you can access that, whether that be through Centrelink benefits or whether that be you're early in that piece and you're wanting to create that wealth strategy so you don't end up below that modest amount or below that comfortable amount. So whatever makes sure that you have enough funds in there, that's what will work together. That's the value that an advisor adds. Figure out where you are right now, and if your retirement goal is to make sure that you can keep your, living expenses maintained, we'll try to aim for that, and we'll graph that out as best as we can. So the piece of software that I've got, it has in there thousands of assumptions, pieces of information, and right now I reckon the best thing is that inflation figures have adjusted, and when I go back into my clients' portal and I have a look at how they're tracking, because of inflation, rather than being up here, they might have sort of come down that little bit because inflation's more than what we expected 3 or even 6 months ago. So it's about getting back in contact with clients, explain to them we might have to adjust a few things, whether that be 1, your expectation, or 2, your investments, or 3, your strategy. And we'll adjust that to make sure that we keep you in line as to where you should be. Anything that opens up, we'll make sure that we get there. So there's quite a few things that we can do. I guess that kind of brings us back to that previous question about value. But in terms of a comfortable retirement, we'll make sure that you get there. That's the whole idea.
so it's a constant monitoring of a person's situation, financial situation, and advising them on what's happening in the market about the inflation, their basically estimated cost in future according to the predictions and the software that, for instance, you're using. So it is very important. Expense is very important, as the same as the income. I really like Buckminster's Fuller definition of wealth. He says wealth is a person's ability to survive X number of months financially. For example, most people think $1 million is rich, but if expenses are 100 grand a month, wealth is only 10 months, correct? So how long you can survive without working is how wealthy you are, basically. And this is what you're doing on a regular basis for your client. You're just analyzing their income and their expenses and tell them, look, in your retirement, you will end up with this amount of money and you can end up, living for a comfortable life for this amount of time. So is this enough? If the answer is yes, that's a good sign. If the answer is no, we have to basically make a plan for them, right? So for those clients that are struggling to meet a comfortable life in their retirement, what are the options?
It depends on their situation. So if they aren't able to achieve their goals, it might be a range of options in regards to the investment. So we start off with a few things. So we'll start off with the strategy. What is the strategy and how do we get you to that point? If the strategy, for example, isn't working, let's readjust that strategy. The next part of it is, and once we've got the strategy down pat, what's the investment? So the strategy might be, the structure as well. The strategy might be, I want to become comfortable in the retirement, or I might want to retire early. And that's fine. That's a question that we get quite a bit. I want to retire rather than at 65 or 67, I want to retire at 60. How do we
Absolutely.
do that? So let's have a look at what the options are. Your strategy is to retire at 60. What's the structure that we do that in? So the structure might be in your personal name, or the structure might be inside of super, or it might be inside of a family trust, or it might be inside of an SMSF. There might be a few other options available, but let's just keep it to the basics. And then the other part of the piece is, well, what investments do we have inside of that? So it's a whole range of different options that we can sort of fill that gap in. But if you want to get from here to here, we've got X, Y, and Z to consider, and that's the part that we've got to fill in, and that's the part that we will discuss and keep track of and make sure that it's monitored and updated, and we can work together to achieve that. It's about accountability as well. You're accountable, I'm accountable, we work together. So if that can't be achieved, again, we'll work towards what that is. But again, that investment might be a mix of managed funds, shares, again, keeping it basic. It might even be property, for example. And this is where me and you come in. This is where you add value to my clients, because I can't pick property. That's not something that I can do. I can talk to clients about shares. I can talk to them about managed funds. I can help them in regards to finding the right fund manager. But I can't say to them, this is a property that you need to purchase because this property is going to achieve X, Y, and Z. What I can do is talk about property as a property or an asset class as a general piece of information. But again, that's where you come in. That's where you come and help my clients and me, of course.
Absolutely.
Where does the client invest? What does the client do? Because we've determined shares might be an option for them, and we've determined property might be an option, and it might be a blend. Most of the time it is. You don't want to have just one asset class, and if something does happen, you want to diversify. And we're all about risk mitigation. So it's about diversification for the client. So that's where you'll come in and have a chat with the client and then say, this is it.
Absolutely. So a very important note. So for many clients, investment, it doesn't matter, shares or property or whatever, according to the situation, is not optional. It is not just to improve their quality of life. It is a necessity, because if they don't do it at this stage, they will end up with lacking lots of money in their retirement, and they cannot live, not even comfortably, they cannot live at all with a very limited saving and income that they're gonna have in future. So it's a very important concept, because people think investment is only for rich people, and the people who are rich are going to invest. But we need to be mindful that in order to be able to live in the next 20, 30, 40 years, we have to invest if our situation is unique and we don't have enough money in the retirement, which is a very important thing to understand. Because most of the time, I've seen so many people that they never meet a financial advisor. They don't talk about financial things, and they just think government will take care of them.
Correct.
And they will suddenly come into the situation that just said, oh my God, government is not doing everything for me. They are just doing the minimum, which I cannot even live on that money. So they have to think, they have to plan, and they have to talk to a person who can give them proper advice in the right time, when it is not too late, right? So that's the first important one. The second thing is that there is always an argument between different people who like property and who like shares. And there is always an argument between which one is better. So I have a very nice definition from Robert Kiyosaki, and I don't know if you've heard it from him or not. He mentions this fight is actually absurd, because there are different vehicles to arrive you to a point. It's just like trains, buses, and your own car. So if you're going on a trip and it is 100 kilometers away, you can use your bus, you can use your car, or you can use a bus. But if you're traveling to another city which is 1,000 kilometers away, you have different options. You can use a plane, which takes you in 1 hour there, or you can use your car, which takes you in 12 or 15 hours. So there are different vehicles to basically deliver you to a certain point, which is your investing objectives. So tell us about pros and cons of investing in shares and property.
Yeah, I actually want to touch on something you just mentioned as well. Sorry. So what you mentioned, and it's a very common misconception that, or thought, I suppose, that people have around, I don't have enough money, or the government will look after me because that's what they're there to protect me. As I mentioned before, for someone who is a couple and they want to have a modest, and a modest means that you're not really going to be doing much traveling, going on that hour flight, then what they'll do is, rather than having, say, a modest amount of 43,000 of recommended income per annum, your government pension is going to be around $40,000. So there's a bit of a shortfall there already. And how do we plug that shortfall? Because you can't always rely on the government to, prop you up. You might have to make a few cutbacks. That's your only option. Or we invest what you're getting from the government, but it means further cutbacks just for a better long-term option. So either you do it earlier or you do it at the end. It's hard to sort of guide people through that. And it's the same for a single. There's about a $3,000 shortfall for a single. So even more to work towards in that case. Just going to your other question in regards to pros and cons, exactly as you say. I mean, if you're looking at shares or if you're looking at property, they'll deliver you something different. Let's just say, we'll start off with the share options. If you're looking at shares, there's a whole range of options that you've got available to you. People might be freaked out if it's shares because they may have had a bad experience, or they don't want to be invested in the share market. And that could be for a whole period of reasons, or a whole range of reasons. But say, for example, we're looking at shares as an asset class. We'll look at that whole thing as an asset class. You might have people that pick speculative stocks. So let's just say at the bottom of the chart, you might have speculative stocks. They start at a couple of cents. If they go bad, they go bad. If they go great, they'll go great. That's the whole reason for a speculative stock. At the very, very top, you might have your top ASX 200 listed shares. They're the ones that you've probably got a bit more certainty around, a bit more knowledge, a bit more research, and we're a bit more comfortable with. And that's what we're looking for, comfort at the end of the day. So if your shares are, we're looking at that part as opposed to that part, that might make you feel more comfortable up here. Property, it's the same idea. That's where, again, you come in, because I can talk about the whole asset class. I can't talk about the bottom of the pile or the top of the pile. But the pros and cons in regards to that is, we want you to be comfortable up here. The pros of having a share portfolio, it depends on the structure as well. If it's in pension phase inside of super, all the franking credits come back to you. So rather than saying 70 cents and the dollar goes to an individual and then 30 cents is paid as tax, and then there's an adjustment in your tax return, the whole 100% in pension phase comes to you. So again, that comes down to the first thing, which is what your strategy is, and then the structure. How do we structure it? The cons might be, again, how comfortable are you? So if you're going for that bottom part of the pile, are you going to be comfortable with that? Shares may not perform. They may not perform like you've expected. I mean, if we go back to 2018, for example, shares didn't perform how we wanted them to perform. 2019, 2020, we had a few adjustments. And so you've got to ride that wave. It's a long-term investment. Exactly the same as property. In terms of property, again, it's a long-term investment. With both of them, there's capital gains tax to consider. So if you own an asset for less than 12 months, any of the gains that you create from that, under 12 months, 100% of the gains is taxable to your personal income.
Depending on the structure, though.
Depending on the structure. Again, if it's in a self-managed super fund, there's a different clause for it. Again, it would be contained within the self-managed super fund, again with the trust. But generally speaking, if it's in your name, then it's to your personal income. If you go and look at property, for example, again, long-term. So if you sell it after 12 months, there is that 50% discount to consider. It's not as easy, and you'd probably be far better off explaining this than what I am about flipping a property, for example. You've got to be really, really careful in doing that. Leave it to the experts. Don't just do that because you see it. And again, this comes back to even self-managed super funds. You see your friends doing it, or you hear of others doing it, and people think, I can do that as well. You've got to be really careful. Get the right advice. Leave it to the experts. Make sure that you're getting what you need out of that. Don't just do it blind because you think, I can do the same. It's going to be very hard.
So these are all important things that people need to consider before deciding which vehicle is suitable for them. Again, with the help of the financial advisor for sure. And you mentioned a fantastic point, Angelo. You mentioned about people saying, my friend has done this, so I'm going to do the same thing. It is basically that concept of one size fits all strategy that we hear very often. In property, you will see that many people say, my friend has bought a property in that suburb and he's very happy with his investment, so I'm going to do the same thing. But we're forgetting that we don't have the same risk appetite. We don't have the same investing objective. We don't have the same cash flow. We don't have the same job security. We don't have the same personal financial situation. So the best suburb for Amir is very different to the best suburb for Angelo. So
Correct.
for me, it's just, it's just common sense. There is no one size fits all wealth creation strategy. And we really need to be careful about the people who are saying, they are selling their product by saying our product is fantastic for everyone. And, no matter what your situation is, come to me, you become a millionaire overnight, or, buy this house and land package. This is the most, profitable investment that you can ever have. So we really need to understand that concept and, plan and think about our situation first before making any decision, and don't think that our friend's situation is exactly the same as ours, and our friend, our colleagues, our family members are not the best person to get advice from, because they only know their situation, not our situation, and they have limited experience and knowledge, which is very common. So I'm going to ask you one property related question, and that's basically property investing through super or SMSF. This is a common question, especially for the people who have enough money in the super, but they don't have enough money in their bank account. So they start thinking, maybe it's a good idea that I buy something in my super. So can you please just tell us a bit about this concept and the pros and cons of this strategy?
Yeah, of course. Self-managed super funds are a complex beast. So
Absolutely.
I think people have this idea that it's as simple as creating a self-managed super fund and just off you go with a property. There's quite a lot to consider. There's quite a lot to be concerned about, because rather than, let's just say it's your super fund that you've had previously, whether that be an industry fund or a retail fund, now that's you. So anything that goes wrong, that is on the trustees. Depending on how you structure the trustees, depends on how that could occur. But let's just say, for example, most people will create a self-managed super fund, and within that, they'll then create a corporate trustee. Not everyone does that. There are those who create self-managed super funds with individual trustees. A good way to think of it as a corporate trustee is that's a business, and people can hop in and out of that business. Within that business owns the assets. Individual trustees, it's the individual trustee, and hopping in and out can be a bit more complicated. Creating it with individual trustees is a bit cheaper, but the concern is if there is anything that goes wrong, each and every individual trustee is liable for any penalty. And again, that can include quite a high amount of penalties that they'll have to incur themselves. Whereas if it's a corporate trustee, it's split between the business, and then it goes down to the individuals. But that's one thing to be really, really mindful of, is that everything falls onto your shoulders should anything go wrong. And it's not as simple as, let's just say you buy a property, as you mentioned before, can you get a loan for it? Do you have enough of a balance inside of your super fund? Do you have enough people? And the good thing is, a few years ago, we went from having up to 4 to up to 6 members in a self-managed super fund, so long as the trustee allows for that, if they're existing. That just means that now, rather than having 4 people that can be invested, it can be now up to 6 people. So it might actually help boost up what that balance is. Years ago, when I started, there was a recommendation for $200,000 to be a minimum amount before you created a self-managed super fund. Of course, that's changed. So that's now sitting at $500,000. So it's more than doubled during that time.
And why is that, Angelo?
It really comes down to making sure that there are enough funds. A lot of people have been creating self-managed super funds, I guess, unnecessarily. There's over 600,000 of them in the country. Again, if we have a look at what they actually own, some people just create them for all the wrong reasons. And I've seen that time and time again where they've been advised to create a self-managed super fund, to own property inside of that, or own shares, or just silo it to just shares or just property. And it's probably not the right advice for them. So that's where the recommendation came around $500,000. It's not a hard and fast rule, it's a recommendation. So it's guidance around that. At the end of the day, it does come on to whoever created the self-managed super fund, but as advisors, we have to make sure, is this the right thing for you? Are you comfortable with what happens? So we have to look at what the costs are of creating it. We have to look at the penalties, if there is any penalties that could occur, and how they get distributed if that's the case. And that can happen from error. And it may be an error that you weren't mindful of or you weren't aware of. And again, that's not an excuse to not pay for a penalty. Making sure there's no breaches, because that can have an impact on the tax effectiveness of the self-managed super fund. And again, that goes up to 47 cents on the dollar. So you've got to be really, really careful, because the whole idea of super is for your retirement, and you're in a 15% or a 15% even tax environment, but it can go up quite a bit if you're not careful. Also, the biggest thing with property, and this is the biggest misconception, is that you can't use it. If you have a self-managed super fund, you can't use it. You can't go in there. You can expect it when you're purchasing it, but that's it.
Yeah.
So say, for example, if I purchased a property in a self-managed super fund, I can't then go to that property and live in it. I can't move in. I can't go there on a holiday.
And even your related, your relatives cannot go there. You cannot, buy a property in your SMS and, SMSF and tell your basically children to live there.
Yeah.
So it's illegal. So there are lots of legislation around SMSF and property investing in there, which basically limits lots of people from achieving what they want to achieve in their investing journey. So they need to be really careful about many legal aspects.
Yeah, and that's the thing. That's what people don't, I guess, get out of a conversation when they're having, at a barbecue, that their friends have created a self-managed super fund. It sounds great. It sounds fantastic, but they can't use it. Their relatives can't use it. Friends can't go there. It's kind of pointless if that's what your intention is. It's not going to happen. Penalties will most likely occur if that's the reason why you created it. And also, there's the concern around the tax issues. So is it even worth it? So the other part of it is as well, again, that whole recommendation around having $500,000, the cost of actually creating a self-managed super fund may not balance out. So rather than having a self-managed super fund, it might be worth having a super fund which acts very similar to a self-managed super fund, but rather than paying for the creation of the self-managed super fund, going to the accountant, getting that audited, making sure all the paperwork is in order. You're looking for thousands of, to be upfront, quite a lot in terms of setting it up. So thousands of dollars just to start that self-managed super fund, and then the ongoing accounting of that. So again, there might be, say, $5,000 or $7,000 to create it, and the ongoing maintenance might be around, $2,000 or $3,000 a year just to have that. And if you're owning just shares, it may not be worth it at that point. Again, every situation is different, so make sure you get the right advice around that. But if you're wanting to own property, you've got to make sure you're owning it for the right reasons. Only time you can use a property that's in your self-managed super fund is for a business which you own, and there's a commercial agreement. It has to be paid on a commercial basis. So there's an agreement Even though it might be between yourself and yourself,
You
but
and yourself.
it's still an agreement between you and a business, but you're paying market rate. So again, got to be audited, got to be above board. That's the only time. It cannot be a house, it can be a commercial property. Again,
Absolutely.
make sure you get the right advice around that.
Thank you so much, Angelo, for being here today and unconditionally sharing with my audience. I really appreciate you. So how can people find you?
Go to divergentwealth.com.au. There's a whole bunch of details on there, so you can reach me that way, or Google Divergent Wealth, based in Melbourne. There's another one in the US, but it should come up with Melbourne if you're here in Australia.
Thank you very much, Angelo. So if you've liked what you've heard here, please like our channel and leave us a comment. And on that note, this episode is a wrap. We'll see you guys again very soon. Bye for now.